Okay, so if you're a director of a limited company here in the UK, then listen up. You have access to one of the most powerful tax-efficient investment tools out there. It's all about your pension, specifically using your company to contribute to what's called a self-invested personal pension, or a SIPP. Think of it as your own private pension that you're in the driver's seat of. And when you use it this way, it is an absolute game changer. So let's dive right in.
So let me ask you a question. How much tax do you think you really pay on your company's profits? Because, before you can actually get your hands on that hard-earned profit to invest for yourself, that money has to go on a really long and very, very expensive journey through the tax system.
And this is that journey. First, your company makes a profit. Great. Then HMRC takes its slice through corporation tax. Then you pay the rest out to yourself as a dividend. And guess what? Your personal tax bill takes another huge bite. It's only what's left over at the very end that you can finally invest. It's a path that just leaks value every step of the way.
All right, so here's our roadmap for this explainer. We're going to start by digging into that double tax problem. Then we'll introduce a really powerful solution, see exactly how it works, and run through all the tax advantages. Of course, we'll cover the risks and limitations, and finally, look at how you actually get your money out when the time comes.
So, let's kick off with the core problem here. That journey we just looked at? Think of it like this. Every single step is pretty much designed to shrink the amount of money that actually ends up working for you.
But what if there was a shortcut, right? What if you could take that profit and get it invested before all those layers of tax get taken out? Well, that is the core idea here. By having your company contribute directly into a pension, you literally sidestep almost all of that corporation tax and personal dividend tax.
And that brings us to this powerful, almost elegant solution, the company's SIPP contribution. Honestly, it is widely seen as the single most tax-efficient way to get profit out of your UK business and into your long-term future.
Okay, and this is absolutely crucial to understand. You see, a personal pension contribution is limited by how much salary you earn. But a company contribution, that's paid straight from company profits, and it is not tied to your salary at all. This means you could pay yourself a tiny salary, but still have your company make a massive pension contribution on your behalf.
So you might be thinking this sounds complicated, right? Well, let's look at how you actually do it, because the mechanics are surprisingly simple.
First up, you open a self-invested personal pension, a SIPP, in your own name. Easy. Then your company, not you, your company, makes the payments directly to that SIPP provider. In your company accounts, you just record this as an employer contribution. And here's the magic part. That payment reduces your company's taxable profit for the year. Boom!
Now, of course, there's always a rule, right? It comes from HMRC, and it's called the wholly and exclusively test. It sounds a bit jargony, but all it really means is that the contribution has to be a legitimate business expense. For pretty much any director, this is a no-brainer. The pension contribution is simply part of your overall pay package for all the hard work you do.
All right, let's get to the really good stuff, the tax advantages. This is where you see just how much money this strategy can save you.
First up, the big one. Corporation tax. Because the contribution is a deductible business expense, it slashes your company's profit right away. Depending on your profit level, that's a saving of up to 25% on the entire amount you put in. That's huge.
And the second win? Honestly, it's just as big. Unlike a salary, there is zero, none, zilch, employers and employees' national insurance to pay. And with the employer's rate sitting at 13.8%, well, you can see how that adds up to a massive, immediate saving for your business.
Okay, theory is one thing, but let's put some real numbers to this to see what it actually looks like. Let's say your company has £100,000 in profit that you want to put away for your future. Let's compare the old way with this new, smarter SIPP strategy.
So look at the numbers side by side. Option A, the old school dividend route. You pay corporation tax, then you pay a hefty chunk of dividend tax, and you're left with less than 50 grand to invest. Now, look at option B. The company puts £40,000 directly into your SIPP. And here's the kicker. The company also saves £10,000 in corporation tax right off the bat.
And this chart just hammers home the trade-off, doesn't it? Sure, the dividend route puts more investable cash in your personal pocket today, but the SIPP route does two incredible things. It gets a massive £40,000 of pre-tax money growing for your future, and it saves the company a cool 10 grand in tax. It is just such a powerful way to use company profits to build your personal wealth.
Okay, I know this all sounds almost too good to be true. And you're right, it's not a complete free-for-all. So to give you the full picture, we have to talk about the rules and the important catches. So here are the main rules you need to know. First, there's an annual allowance, currently £60,000. Now, something really powerful here is that you can often carry forward unused allowances from the last 3 tax years. Second, and this is the big one, your money is locked away until you hit pension age. I can't stress that enough. Third, remember a SIPP is an investment, so its value can go down as well as up. And finally, tax rules can and do change. And that really brings us to the core philosophy here. You have to think long-term. This is absolutely not a strategy to get your hands on company cash for a new car next year. It's for building wealth for your retirement.
And of course, we have to put our sensible hat on for a second. This is all general information, not personal financial advice. Everyone's situation is different. Tax rules can be a minefield. So please always talk to a qualified professional before you do anything.
Okay, so let's fast forward. You've been doing this for years, your pension pot is growing beautifully, tax efficiently. How do you actually get that money out and start enjoying your retirement?
Well, once you hit pension age, currently 55, but that is rising to 57, you can typically take a massive 25% chunk of your entire pension pot completely tax-free. Just gone, in your pocket, no tax to pay. The other 75%, that's what you'll use for your retirement income, and it gets taxed as regular income whenever you decide to draw it down.
So here's the real pro tip, the big idea behind all of this. You're not really avoiding tax, you are deferring it. Think about it. You get the tax relief on the way in, when your company is profitable and you're probably a higher rate taxpayer. And then you pay the tax on the way out, in retirement, when your income is likely much lower, meaning you'll be a basic rate taxpayer. It's a brilliant bit of tax planning.
So at the end of the day, it really all comes down to this one question. For long-term planning, a company's SIPP contribution is without a doubt one of the most powerful and totally legal tax strategies a UK director has. So the only question you have to ask yourself is this: is your company's profit building your future, or is it just building the taxman's?